If GCC states increase private sector involvement in their economies, they could avoid $165 billion in capital expenditures by 2021, says a study by management consultancy Strategy. According to the study issued by the Ideation Center, the leading think tank for Strategy in the Middle East, they could also generate $114 billion in revenues from sales of utility and airport assets and up to $287 billion from sales of shares in publicly listed companies. GCC states could also narrow the innovation gap with other countries, enhance the delivery of and access to government services, and improve their infrastructure. With more private sector participation, these countries can achieve operational efficiencies of 10 to 20%, reducing government budget deficits. Greater PSP could also help them close their innovation gap with other countries. Between 2013 and 15, 70% of global innovation stemmed from the private sector versus 13% from the non-profit sector and only 8% from the public sector. Recently, GCC countries have been facing a few long-term challenges to the sustainability of their economies. A high dependence on oil for government revenues, 73% of revenues and 82% of exports are linked to oil, a lack of workforce diversity and skills creating unbalanced labour markets, and a growing need for public services such as healthcare, infrastructure and education, and an underdeveloped ecosystem for innovation, which is a key driver of national competitiveness. According to Strategy, increasing PSP through the establishment of public-private partnerships and the privatization of government assets is an ideal response to these challenges. Expo 2020 Dubai will award 47 construction contracts worth 11 billion dirhams in 2017 as preparations for the first World Expo in the Middle East, Africa and South Asia continues to gather pace. A further 98 non-construction contracts totaling more than 360 million dirhams will also be distributed before the end of the year. These will range from legal advisory services to event management and merchandising. The construction contracts for 2017, which are open to local, regional and international businesses, include the third and final infrastructure package for the event support areas, including car parking. Other key awards for the year ahead include the construction of the 3 thematic districts that will host the majority of the pavilions, as well as the public areas, and the design, development and delivery of all temporary architecture and infrastructure required to stage the event. The Expo 2020 Dubai e-sourcing portal includes details of upcoming tender opportunities as well as announcing contracts already awarded. These will range from smaller contracts to larger multi-billion dirham opportunities. In 2016, Expo 2020 Dubai awarded over 1,200 contracts investing more than 2 billion dirhams in the economy. This work includes irrigation and sewage, pipes and cabling, roads, electrical and water, telecommunications, ducting. Ahmed Al-Khatib, Vice President of Real Estate and Delivery Expo 2020 Dubai, said while 2016 was an important year for design, 2017 is when the momentum of construction will really build ahead of international participants beginning work on the pavilions in 2018. Passenger traffic at Dubai World Central, Dubai's second international hub, witnessed a strong surge in 2016, climbing 84.5%, according to the traffic report issued by operator Dubai Airports today. DWC welcomed a total of 850,633 passengers in 2016, up 84.5% compared to 461,063 passengers recorded in 2015. During the fourth quarter, passenger traffic at DWC totaled 248,405, up 39.9% compared to 177,608 passengers recorded during the last 3 months of 2015. Passenger traffic growth at DWC is mainly driven by Fly Dubai, one of Dubai's 2 flagship carriers, which operates on average 41 weekly flights to 5 destinations from DWC, in addition to its operations at Dubai International's Terminal 2. DWC is currently served by 27 passenger carriers operating an average of 108 flights weekly to 44 international destinations and is home to 64 scheduled cargo operators that fly to as many as 138 destinations around the world. A Japanese study has said that the UAE's support for renewable energy contributed to make solar energy cheap, and it is now becoming cheaper to produce, with bid prices for solar and wind-powered projects in Europe and the Middle East dropping to levels comparable to coal-fired thermal power. The study conducted by Japan's Nike said that the UAE's Dubai Electricity and Water Authority (DEWA) received bids in the range of US 2 cents per kilowatt hour in proposals for solar projects with long sunlight hours in the Middle East, ensuring stable production of solar energy. The study also noted that a Chinese-led consortium with a bid of 2.42 cents per kilowatt hour successfully built a 350 megawatt solar plant. DEWA also awarded a solar project in alliance led by Mazda at a strike price of 2.99 cents per kilowatt hour, it said. As per data from the International Energy Agency, solar energy production costs have dropped 80% in the last 5 years, while onshore wind power costs have fallen by nearly 70%. Onshore wind power costs have fallen below 10 cents per kilowatt hour. Coal-fired thermal power typically goes for 5 to 7 cents per kilowatt hour.